So Hayes Plec actually beat consensus on pre-exceptional operating profit today, hitting 48.6 million against the 45.3 million expected.
Right, but looking at the top line, net fees revenue fell 8% like for like, down to 905.5 million, and basic loss per share widened to 3.64 pence.
Yeah, driven by a massive statutory pre-tax loss of 54.5 million due to 89.6 million in exceptional restructuring charges.
Exactly. And for guidance, management is targeting an additional 45 to 50 million in annual structural savings for FY27.
Which gave retail investors absolute whiplash today. I mean, the stock initially dropped over 5% pre-market on that statutory loss.
Oh yeah, an immediate dump.
Right, but then aggressively reversed course. Surged 6.10% by the close as institutional investors bought into the underlying profit beat and that rapid cost cutting.
And it really was that underlying segment data that convinced those institutional buyers to step in and buy the dip.
So let's break that down because the divergence here is wild. Temporary and contracting placement was down 5%, but permanent placement fell 12%.
Right, 12%. And geographically, it's a totally mixed bag. Germany, which is their largest market, saw operating profit drop 24%.
But then over in ANZ, Australia and New Zealand, they actually doubled their operating profit.
Yeah, and the UK and Ireland is maybe the craziest part. That region swung to a £4 million profit despite a 10% fee decline.
Wow.
Purely through cost discipline, just relentless cost cutting.
Okay, let's unpack this because, I mean, it's like bailing water out of a sinking ship. Top-line revenue is shrinking, but they are slashing costs so aggressively that the margins are actually floating higher. Is that even sustainable?
Well, that's the big question, right? Slashing costs alone isn't a strategy. Which brings us to CEO Mark Durnley's newly unveiled momentum turnaround strategy.
Right, the portfolio concentration.
Exactly. They aren't just shrinking blindly. Hayes exited 6 European countries, closed 30 offices, and now they're narrowing their focus to 16 core countries and 6 global specialisms.
And they're specifically targeting higher value roles, right? The £45,000 to £120,000 salary band, plus aiming to increase consultant productivity by over 50%.
Yeah, and there's a very specific reason why. They are actively retreating from high-volume, low-margin generalist roles.
Because of tech disruption.
Exactly. Those volume roles are highly vulnerable to AI automation. So instead, Hayes is pivoting to a human-in-the-loop model.
Right, because when you're hiring in that 45K to 120K band, the cost of a bad hire is incredibly steep. You definitely don't want an AI hallucinating the qualifications of a key employee.
No, absolutely not. You need human judgment managing that risk.
But I mean, shifting to the risks here, they're shrinking their footprint drastically. What happens if the macro environment just refuses to play ball? The biggest headwind is that permanent hiring remains super depressed right now.
Yeah, companies are just hesitant to commit to permanent headcount. And management even flagged that September is the critical bellwether month. They are watching it closely.
So as you're listening and trying to evaluate the stock, it leaves you pondering, right? If Hayes successfully achieves its targeted 25% plus conversion rate on this drastically shrunken global footprint,
Yeah.
does the future of global recruitment look less like a volume staffing agency and more like, a niche boutique advisory firm?
It's a fascinating thought. The entire industry model might be shifting.
Definitely something to watch as those September numbers roll in. Make sure you follow the show for daily earnings coverage.